The time is 1:37. Members present: Representative Knopp, Representative Laban, Representative Pelton, Representative Carpenter, Vice Chair Ortiz, Co-Chair Foster, Representative Sullivan-Leonard, Representative Josephson, Representative Wool, and Representative Merrick, and myself, Representative Johnston. Today's agenda, we will be reviewing model scenarios from legislative finance for House Bill 306, which is the PFD GF Appropriation Earning Reserve Bill, and House Bill 300, which is the Permanent Fund Appropriations from Earnings Reserve. The House Bill 306 and House Bill model scenarios will be modeled by Alexi Painter. And Alexi, would you please come to the front with Pat Pitney? Put yourselves on the record.
For the record, my name is Pat Pitney. I'm Director of Legislative Finance.
Alexi Painter, Legislative Finance Division.
So I'd like to make a few opening remarks and then be available as there's questions. Alexi will do the vast majority of the presentation. The projections that and the modeling that we're doing today that were the static versions, and we're doing the static versions because it's much easier to explain, especially for the people who are looking at the materials that are on the website. But they're built on an updated oil forecast and an updated POMV forecast. And the reason we've updated those is because the dramatic change in the market and the dramatic drop in oil price in the last couple weeks. That drop in oil price, there's futures are trading at $40 a barrel, and that's as good a predictor as anything to say what it's going to be. Department of Revenue usually comes out with an updated forecast. They usually present that towards the end of March because it was so dramatic of a change just in the last 2 weeks. We felt it would be irresponsible to assume we were going to get what was forecasted last fall when the markets are telling us something very different. And so I just wanted to preface that before Alexi gets started.
And personally, I'm happy that you've done that. I think it's safe in looking at the futures market that actually this last revenue report by the Department of Revenue said that they put a lot of emphasis on the futures market when they were doing the revenue forecasts this fall. So I think it's a safe assumption. What was your assumption as far as the draw from the permanent fund?
So there's a full slide on that particular assumption, and I think in 2 more slides we'll get to it.
Okay, great, thank you. Any other questions before we begin? Please begin.
Okay, so to reiterate what Pat said, the spring forecast is coming out soon.
Alexi,
but
did you put yourself on the record? Or did
sure, I did already, but I can do it again. Alexi Painter, Legislative Finance Division. So the fall forecast that DOR released assumed a $59 a barrel price of oil in FY21. That was based on the futures market at the time. There's no direct futures market for Alaska North Slope crude, so generally we use the one for Brent, which is a global waterborne crude for all of the various crude oils that are moved on tankers. Generally, Alaska crude tracks very closely to that. So that is a pretty good stand-in for the price that we will be getting for our oil from Alaska. So the price as of yesterday of Alaska North Slope crude was about $37 a barrel. For these models, we're using $40 as the base price for FY21. The futures market for Brent shows that the price climbing to $40 sometime during fiscal year 21. So this is a pretty reasonable number. If I were to do this today rather than Monday when I prepared this, I probably would have used $41. That's a little closer, but pretty close generally. For the rest of fiscal year 20, we're assuming that the average will be $40. Again, that may be a little over optimistic for the next few months, but that's a nice round number. That would result in FY20 of a revenue reduction of about $300 million versus the fall forecast for this fiscal year. It would mean that we would end with a price for the fiscal year of around $55 versus $63 that was projected in the fall. So that would result in, with the governor's supplementals, about an $800 million deficit in FY20. For FY21, the impact of going with this lower price assumption is about $550 million, and that is really just the oil market. That's not factoring in any other tax changes due to coronavirus or any other factors that could impact our tax revenue. To give an idea of some other impacts that we could have to our revenue that are not captured in the oil market, the revenue forecast called for about $50 million of unrestricted investment revenue. That's just basically interest earned on our savings accounts. In the low interest rate environment that we appear to be entering, $50 million may be high. Last year, we got about $16 million of corporate income taxes from the tourism industry. With the hit to cruise ships this year, again, that may be high. So $550 million as a reduction is probably, if oil prices hold, is probably a little on the conservative side, but again, we're trying to use round numbers that we can easily find. So that's what we're going with until we get a new spring forecast.
What did you have any idea as far as the fishing industry?
Madam Chair, I do not have a good idea of the impact. There likely will be some impact to price for fish this summer, but I don't really know the scale of that, and the spring forecast may address that. And again, $550 million is maybe conservative, $600 million may be a more realistic assumption if you include these secondary non-petroleum impacts of the coronavirus.
Thank you. Please continue.
So the next assumption is oil production. We're still using the fall forecast for that. To date, production has actually ran slightly below that, but not significantly compared to the difference in the production forecast, so we're comfortable sticking with that forecast at this point. The fall forecast shows essentially 500,000 barrels a year, or a day, sorry, for the next decade. It declines a little bit and then rebounds a bit as some of the new fields are presumed to come online. Our fiscal model also has the low and high production forecast that the Department of Natural Resources prepared. The low forecast assumes essentially that very few or no developments of these new projects that we've heard about actually succeed, and that shows production steadily declining to about 320,000 barrels by FY29. The high forecast is the optimistic case, assuming that most of these developments succeed. It shows production of nearly 700,000 barrels a day in FY29. And again, these are based on the fall forecast. It's possible that with a different oil price assumption, DNR will end up revising their production forecast in the spring. The permanent fund earnings, once again, to keep up the trend of bad news, market performance has not been great this year. We're using the low scenario by the Alaska Permanent Fund Corporation for FY20, which is a slightly negative total return. That would put the total fund balance at the end of this fiscal year at about $63.5 billion. That's about where we are today. So we feel that that is a reasonable return to assume for this fiscal year, given the stock market's performance this year. We are then using their forecast beyond that of 7% total return starting in FY21. And one thing I want to point out that's in the second bullet here is that the low return scenario still assumes that there is a statutory net income that's positive this year, and despite the negative total return, and that's reasonable based on how much they've already realized. It's also important to realize that, or to note that the reductions in the stock market essentially bring the stock market back to where it was in 2018. So while that looks like a big decline from where we are, when they're rebalancing away their portfolio, they may have bought that stock before 2018, so they'll still show an increase, and they'll still have realized gains when they sell that asset. It won't be a realized loss because really the last 2 years have been very positive, and this is just unwinding some of that. It's not like 2008 where we were actually selling assets at a loss.
Representative Carpenter?
Thank you, Madam Chair. Just wanted to clarify or confirm. You said $63.5 billion by end of year, calendar year 2020.
Representative Carpenter, through the chair, that's by the end of the fiscal year 20.
By July.
Yes.
Follow-up? Representative Ortiz?
That number was after paying out everything.
The current value, projected value, is $63.5 billion of the PFD, despite that it was around 67 not that long ago. Is that what? Did I hear you correctly?
Representative Ortiz, through the chair, I checked this morning at their value yesterday, and I believe that was about what it was. I'd have to double check to make sure it was exactly that, but it was about where the low scenario projected for the end of the year.
Thank you.
Representative Josephson?
Thank you. Through the chair, Mr. Painter, and this may be better for Ms. Riddell, and she's not here, but if you know, and if you don't, that's fine. What is it that was realized or may have been realized that is shielded or protected from a bear market or recession? If you know what that is.
Representative Josephson, through the chair. So part of that is that they have about $1 billion to $1.5 billion of dividends and interest and real estate rent that comes in as statutory net income pretty much no matter what happens with the market. In addition, they've already realized gains throughout the year before this stock market decline, and so those aren't going to be erased because of this happening now. And then, as I was getting into a little bit, even as they may shed some old stocks, if they were purchased before 2017, they're still going to show an increase from when they were purchased. They'll still realize a gain, even though they're significantly below their peak. And their peak may have been a few months ago, but it still would have a gain from when they were purchased. Okay, so other assumptions. So our default assumption is the spending would be the governor's amended operating capital and supplemental budgets, and then growing with inflation from here on out. I think there's some scenarios in here that show different ones, but that is our default assumption. We assume the supplemental budgets in future years will be $50 million, not the $300 million we have this year, because it's assumed that most of that spending is being corrected in the operating budget this year. We're also assuming CBR earnings from the fall revenue sources book. We actually have a slightly different CBR deposit assumption for FY20 because already we've exceeded that forecast in FY20, so it's a little bit higher than the fall forecast, but it's, from what we understand, that'll be corrected in the spring forecast. We're also assuming no inflation proofing for 4 years due to the intent language included with the $4 billion transfer last year. That intent language actually said that it would serve as inflation proofing for 8 years, but that was attached to a $9.4 billion transfer. The governor vetoed that down to $4 billion. So rounding that $4 billion roughly counts for 4 years of inflation proofing. The House budget that this body adopted did include inflation proofing, but again, our default assumption is kind of ignoring what's happening and going based on the governor's budget.
Representative Carpenter?
Thank you, Madam Chair. So in regards to the $4 billion transfer, this is kind of adding on to that a little bit. What was the balance of the ERA at the beginning of the fiscal year 20? And then what will the balance of the ERA be at the end of fiscal year 20?
Through the chair, Representative Carpenter, I do not have those numbers in front of me. When we get to the model, it'll be a little easier. I don't want to guess incorrectly without them in front of me.
And what numbers are you using for rate of inflation?
We're assuming 2.25%, which is still the official inflation forecast by Callan, which is our investment advisor. that may be a little high in the near term and a little low for the long term, but that's the assumption that we've been using for a number of years at this point. Okay, so seeing no further questions, we'll get into the model. So I will briefly, I think most of you have seen this before, but I'm going to walk through all of the features here, and I think it's been changed a little bit. So the first scenario we're showing is the governor's budget. So in the top left, this is the unrestricted general fund revenue and budget. The blue bars are traditional petroleum and non-petroleum revenue. The green bars are draws from the earnings reserve that are according to some sort of statutory formula. The orange bars are draws from our savings accounts like the CBR and SBR. The dotted black line, or the dotted lines, excuse me, is the total budget. The solid line is the budget without dividends. And so the governor's budget, when it was released, was balanced out of the constitutional budget reserve at a $40 oil assumption. You can see this bar does not quite meet the line, so the CBR would run out, and there would need to be another deficit filler in the governor's FY21 budget. So this top left, in scenarios in which there's this white space, that means that we don't have a planned way to meet that. We could meet the budget through drawing from the earnings reserve or some other method, but we're not necessarily going to tell you what that method would be. We'll just indicate with this white space that means there's not enough money to pay the bills in this scenario. The bottom left shows our budget reserves. The tiny little sliver you can barely see here in FY19 was the last of the SBR, statutory budget reserve. The orange is the constitutional budget reserve, and again in this scenario it would run out sometime in FY21, so it's zero after that. The green bars are the earnings reserve account. We have that in budget reserves, but it's not truly a budget reserve because we do have a planned draw of how it would be spent, so it doesn't quite function as a budget reserve, but for this purpose we do count it there. Below that, this table is just sort of the numbers underlying some of the charts. It shows the ERA balance, the surplus or deficit in this scenario, the CBR and SBR balance, and the percentage of the budget that's coming from savings. Top right, we have the dividend check going to Alaskans in this scenario. In the governor's budget, that amount would be about $3,000, a little less now using this lower permanent fund assumption, but about $3,000 in FY21.
Lexi, actually, could you walk me through that? Because when we're doing a 5-year look back, and we're also drawing down the earnings reserve account, if you look at the top left or even the middle left, I'm surprised that the dividend would stay. Not only, I mean, there's a little dip in the dividend, but that it continues to climb. How do you get there?
Madam Chair, this scenario does not necessarily assume that we're using the ERA to fill the deficit. It just leaves that gap unfilled. So this number, this projection is really just indicating if we don't have to draw extra from the ERA, what the dividend would be under the current statute. Obviously, to meet this $2.5 billion deficit, we'd have to draw it from somewhere. Presumably that would be the ERA and could cost the dividend, but for this scenario in particular, we're not assuming any use of the ERA beyond the current statute. And so you can see the impact of that if that gap were filled out of the ERA in this graph here in the bottom right, which is the impact of ERA draws on POMV. This is assuming that the deficits are made up out of the ERA. What would the impact to the percent of market value draw be? And one important assumption here is that this is essentially taking out the 5-year average. One of the challenges we have in this model is that because we have a lagged 5-year average for the percent of market value draw, a 1-year draw from the ERA is it's not really going to show up for several years, so it's very hard to see the impact of what you're doing. So this just removes the average, or the 5-year average. It's just the entire impact. So if you draw $1 billion out of the ERA, that reduces your POMV by 5% of that, so $50 million. Once it's worked through the average, but this is kind of simplifying so you can really see that impact. And so you can see that if we did fill this deficit through the ERA, it would result in the percent of market value draw, instead of rising to, about $3.8 billion by FY29, it would actually decline to about $2.7 billion. So it would be a significant difference in the percent of market value draw if this deficit were made up out of the ERA.
So if somebody was looking at this and they saw the dividend check line, and then they saw the bottom right, the dividend check line really is not anywhere, any part of the model. It's just saying that, in fact, I don't know how you'd get to those dividends, except that if you continue to have the fund be as large as it is and grow. Anyway, you see my problem with this.
We're not assuming how you're going to fill the deficit. We don't want to assume that you would cut the dividend, or that you would draw from the ERA, or that you would cut education, or that you would cut any item in particular.
This is called fairy dust.
Well, this is essentially just showing that it's broken.
Yeah.
And then.
I'm sorry, I don't mean to, but I could see a large disconnect here because this is built on fairy dust, the top right, and what we really should be looking at are the lower two models. Thank you. Representative Representative Sullivan Leonard. Sorry.
Madam Chair. Alexi, I have a question with regard to the numbers I'm seeing for the earnings reserve account for FY20. Can you tell me how you came to the conclusion that it's $12.698 billion for the ERA?
Representative Sullivan Leonard, that is the total that it would be under the low scenario that the Permanent Fund Corporation provided. So with the lower than their old projection for the statutory net income for FY20, that would be the ending balance in their forecast.
Just do we know what that is?
$12.698 billion for the ERA.
Representative Sullivan Leonard. That is the total that it would be under the low scenario that the Permanent Fund Corporation provided. So with the lower than their old projection for the statutory net income for FY20, that would be the ending balance in their forecast.
Okay, I follow up, Madam Chair. I guess what I'm looking at is, I think we started with 18 billion. We took out 3 approximately for POMV, took out around 4.6 or 5 for the for the corpus, so I'm seeing it more that probably it'd be closer to 10. So that's why I'm questioning, because I'm just doing simple math here, but I'd like to see the real numbers that we're going to be using.
Through the chair, Representative Sullivan Leonard. So the difference there is the earnings that are coming in. Even with the zero total return, there would still be statutory net income entering the earnings reserve account. So the earnings reserve account would still get income in FY21 and already has, in fact, despite the negative total return in this scenario. So that makes up the difference between.
Can you get that for me? Because I'm just not buying it. I think we're at 10.
Yes, we can either get back to or.
I mean, anyway.
And you said earlier that the statutory earnings net, anyways, you know what I'm saying, is about 1.8 billion. Is that what you said?
Madam Co-Chair, I don't think I said what the earnings were. It was 5.27% of the total fund value, but there's a stable 1 to 1.5 billion, but they've already exceeded that for the fiscal year. So
right.
the total would be, I think, about 3 billion, but I'd have to. I can switch to the live model and find that for you.
Through the chair, I can take a try at this. Representative Sullivan Leonard, through the chair. There's 4 components. There's the current value. There's the draws. There's the statutory net income, which is the when a stock is sold, and there is an increase. Then there's the unrealized loss, and it's those 4 pieces that change year to year. Okay.
So this is not part of the presentation to the chair. This is the model itself, so I can actually show these numbers. So looking at FY20, so part of the difficulty here is the difference between the cash balance and the total balance of the ERA, but you can see that the ending balance at the end of FY19 was about 18.5 billion, and then we bring in 3.2 billion in statutory net income, take out 4.6 billion for inflation proofing and the POMV draw, and end at 12.7 billion after the allocation of unrealized gains. And this, I didn't want to talk about the allocation of unrealized gains, but the cash balance of the ERA at the end of FY19 was not 18 billion, it was 16 billion. And then the other 2.5 billion was made up of unrealized gains that have to be allocated between the ERA and the principal, and so they're split up proportion to the value. And so the ending balance is 18.5 million in FY19, or 18.5 billion, and then so the cash balance, again, part of it is 11.7 at the end of FY20, and then some of the unrealized gains are allocated to the ERA, and that's how we end up at 12.7 billion. So if we're just sticking to cash balances and ignoring the unrealized gains, which I think is a much better way to look at it, but unfortunately it's not how the financial statements look, then we're going from 16 billion to 11.7 billion. But you know, if we're looking at total balances, it's going to be 18.5 billion to 12.7 billion. I think that may be where the confusion is the difference between the cash versus the amount including the unrealized gains.
Thank you.
Okay. I feel like
No, actually, you did a very nice job. Thank you.
Okay, so the going back through what we have here in the graphs, the permanent fund balance, we're comparing to the FY20 total balance growing with inflation. So you can see the drop from FY19 to FY20, and then growing with inflation in the red bars. And then we're showing this scenario, the principal and the ERA, and you can see that without any unplanned draws, the value of the permanent fund would nearly keep up with inflation, just slightly below because of the poor earnings in FY20 and the result of that. I already talked about this graph, so I won't return to that. The middle here, all this complicated part, is basically what actually drives these the graphs. These are the assumptions, and these are the variables that we're going to be changing. So, we're using these highlights should help to show what's changing, but essentially anything that's not highlighted is just the governor's budget, which is our default assumption. So it's showing the $40 oil price, the low FY20 investment return in the permanent fund, and then 7% from there on out. We're using the percent of market value draw as specified in SB26, and then the statutory dividend calculation of 50% of statutory net income in this scenario.
Madam Co-Chair.
Yes, Representative Wall.
Thank you, Madam Chair. Through the chair, so the graph of the impact of the ERA draws on POMV, that's sort of an isolated standalone graph, because if that were implemented, that whole page would change, including the one above it, balance of permanent fund, and including the top left, because all those green bars are POMV draws, which would of course be a lot less, since the earnings reserve would be a lot smaller. So, and I'm correct that one is just sort of an isolated kind of study that's in its own little world.
Through the chair, Representative Wall, correct. That's essentially because we don't want to, previously I think we've been assuming that we go into the ERA, and that's not necessarily an assumption that we want to say that we're assuming you're going to break your own law that you passed last year. We don't necessarily want that to be our default assumption. So this is just a way to show the impact if we met the deficit out of the ERA, not to suggest that that is your only option or the option you will choose.
Follow up.
Follow up?
So, and just to reiterate what the co-chair said, the top right showing the dividend check at a statutory level, and the top left showing the budget with the dotted line, they're sort of inconsistent unless you come up with a lot of money, and assuming there's no other big pot of money around it other than the earnings reserve. I mean, the CBR wouldn't certainly cover it, so there's a disconnect there as well, those top two.
Through the chair, Representative, well, I think the point of any scenario that has this white space is that it doesn't work. We can't meet it. You need a plan. A plan that's workable will not have white space. White space means that you have a gap between what's available and what's there, and this is, I don't know that this would be the governor's plan. This is just the governor's budget with no other changes running out, and it would show that we would have this gap starting next fiscal year.
Thank you.
So one other item I'll highlight before I move on is just that this at $40 oil, this budget less dividends line is above the available revenue. So even with no dividend, we would still have a deficit at $40 oil for all the years in the model. So moving on to House Bill 306, and we'll return to 300, but 306 is a little easier to model. So we'll do that
Representative
first.
Carpenter.
Yeah, just another quick question. Kind of hard to determine off of the graph here. Maybe you can shed some light on it. The solid black line, which is our spend line, budget line, from year to year, 2.5% growth. What does that equal in a dollar figure? Just for do we know what that is?
Representative Carpenter, through the chair, do the math in my head, but could find it on the model, but I don't remember that number off the top of my head. But that 2.25% is only applying to the operating and the agency operations and capital budget, not the statewide items that move on kind of their own. The retirement payments have their own schedule, so it's really the roughly $4 billion combined between those two that are moving at 2.25%. So I guess that'd be about $50 million a year to round.
Thank you.
Okay, so moving on to House Bill 306, this is showing 20% of the POMV draw going to the dividend, and the remaining 80% going to the general fund. So this shows that it would reduce the deficit. It does leave a deficit in FY21 of about $800 million after supplementals, and growing to about $1 billion once the POMV draw drops down to 5% next year. And so it would, instead of running out of the Constitutional Budget Reserve Fund in FY21, it would extend through FY22, but would not be sufficient to get through FY23 without other changes based on these assumptions. The dividend, you can see, starts at just under $1,000 and increases gradually to about $1,000 over this period.
Are there any questions? I will say that this looks a lot different than the modeling we had a couple months ago. And it shows you how volatile all of this is. And when we were looking at this before, it gave us a glide path, not a very substantial one, but a glide path as far as our CBR. And you can see how quickly things have changed.
Okay, seeing no other questions, I'm going to go on to House Bill 300, and this is the bill as written, with 15% of the POMV draw going to the dividend, the permanent fund dividend. We're showing a budget change of $300 million increase here, and that's reflecting the community dividend, the 10% of the POMV draw going to communities, as well as a small increase to the university over the governor's budget. We're also showing the capital budget being 10% of the POMV draw. That's about $300 million versus the $140 million in the governor's budget. So again, an increase. And so even though this has a lower dividend than the other scenario, because of the spending increases, the bill as written would result in a deficit in FY21 of about $1.1 billion, rising to about $1.3 billion and larger in future years. And this is assuming that none of the community dividend is used to offset state expenditures, that it's just essentially an additive amount. We'll show some other examples here where it would work a little differently. Are there any other, I guess I should mention the dividend line is matching basically what you saw in the presentation yesterday. Okay, so this next version is a different version that Representative Wool mentioned in his presentation yesterday, where instead of being 10% of the POMV draw, the community dividend would be 5%, and the capital budget, instead of being 10% of the POMV draw, would be 5% as well. So that results in a budget change of $150 million instead of $300 million, and then a lower capital budget assumption as well. And so that now this actually looks very similar to the other bill in terms of its deficits, about $800 million in FY21, growing to about $1 billion in FY22, again, as the POMV draw is reduced from 5.25% to 5%. The dividend number is essentially identical.
Representative Wool.
Thank you, Madam Chair. And maybe you're going to get to it. We talked about school bond debt reimbursement. And do you have a future one where you adjust that? I didn't know if we looked at that. I know I looked at that. I don't know if it's on your chart today.
So, Representative Wool, through the chair, I'll just go to the next version that essentially is assuming that all of those budget increases are paid for by cost shifts, okay, and not assuming where they're going to be, just assuming that there's no cost increase due to the bill. So this is assuming that that increased community amount would be used to reduce some expenses elsewhere. So it's just net neutral to the budget. So that's scenario 5. And then that shows a smaller deficit of about $650 million in FY21, and then about $800 million in other years under these assumptions. Are there any other questions before we move on? Okay, So the next one is what's called Governor's Scenario 5. So this was in the Governor's 10-year plan back in December. They included 5 scenarios, and this was what was called the balance scenario, which was a mix of reduced spending growth, and some sort of tax. I put it in as a sales tax, but it could be any tax. I don't think this plan specified that would raise $500 million, and then a switch of the permanent fund dividend formula from being 50% of statutory net income to being 50% of the percent of market value draw. So in the fall forecast assumptions, this plan roughly balanced the budget. With these reduced assumptions, it leaves a deficit of about $1.2 billion, but that actually declines over time, and that's because of the reduced spending growth rate based on the governor's spending cap that was included in that plan. So we're assuming in this case that it would grow about half inflation. The scenario, I believe the governor's spending cap allows for that amount of growth going forward. Any questions about this one? Did you want to comment on that?
I'd like to make a quick comment for the record. This is Pat Pitney. I think one of the things to pay attention to is on the bottom left, where there's the red bars. That's when our savings, our traditional constitutional budget reserve, statutory budget reserves run out. And in all these models that we've looked at, the latest, the longest it's not been read is to 2023. So I think that our dependence on our traditional savings of the SBR and the CBR is virtually over in these scenarios where we don't have that flexibility to go to, where when we hit the oil price crash in 2014, we had over $15 billion in these 2 accounts. Now, and we were looking at plans that would run from 5 to 15 years. Now we're looking at plans that are 1 year, maybe 2 years, maybe.
And I guess I would add to that, even when there is a fund balance, a projected fund balance of $65 million in the CBR and in FY22 in the one scenario, and $1 million in FY23, we have understood at any one time our cash management needs at least $500 million. So however we look at this, we have not, we're taking our CBR away as a cash management fund. And then I think we also have to then, we'd have to get a legal opinion, even though in our CAFR, our permit fund is a fund balance, whether we can use that in place of the CBR. Representative Sullivan-Leonard.
Thank you, Madam Chair. Just a quick question and a comment. So as I'm looking at scenario 5, so we're looking at a budget change highlighted in yellow, where it's probably reductions of about $500 million, and then in coming down the column we see potential for a 3% sales tax. What's the projection then in dollars for that sales tax?
Representative Sullivan-Leonard through the chair. Our assumption is $500 million for a 3% sales tax. That's based on the fiscal note to a bill that Governor Walker introduced, I think, about 4 years ago. The plan from the governor actually did not specify what tax would be used. It just said new revenue of $500 million, because that happened to be the right amount. That's what I put in, but you could assume it could be an income tax, it could be an industry tax, it could be some other source.
Okay, and then following up with that, then you still said we would see what, a $1.2 billion deficit still, even with that?
Representative Sullivan-Leonard, yes. Part of that is because there's a delay in implementation in the tax. We're kind of optimistically assuming it could be in place by January 1st, and we get half a year's revenue, and that's why the deficit would be reduced in FY22 as you get a full year's revenue.
Okay, thank you.
Representative Ortiz.
Thank you, Madam Chair. Getting back to the line that has the 3% sales tax generating $500 million, does Ledge Finance have at their disposal the kind of information of when, what time of year we collect most of that revenue? In other words, if we were to look at a seasonal sales tax targeting the tourist season, would you guys have the kind of information that would indicate how much revenue that would generate based on how much more revenue, I assume, comes in during the summertime than in the wintertime?
Representative Ortiz, through the chair, we would have to work on some modeling of that. I've looked at studies of seasonal sales tax before, and one of the big issues there is whether local purchases can be timed around it or not. Sometimes in places that have extreme seasonal sales taxes, you'll see people just don't buy cars in the summer, they only buy their cars in the fall. And so you end up with actually less revenue than you'd expect because people time their purchases.
Right.
But you may still see an increase because, again, Alaska's maybe not this year, but in a normal year we'd have a lot of tourists in the summer that would be giving additional purchases. So I think the modeling on that would be complex, and that's something that we'd have to work with the Department of Revenue to get an idea of the true impact of that.
Thank you.
And wouldn't you, in order to model it, you'd really have to what kind of sales tax was it? How many exemptions, besides just the seasonal, if it had a cap? And I think it takes,
That's
yeah.
a good point, yeah.
Representative Josephson.
Through the chair, Mr. Painter, so in this scenario number 6, in the lower left, the growing deficit is a reflection of oil price slumps, which would be more impactful in FY21 than FY20 because we're so well into FY20. And then the drop off is a reflection of half a year's sales tax receipts in FY22. Is that what I'm looking at there?
Representative Josephson, through the chair, the primary reason for the increase of the deficit from FY20 to 21 is actually the dividend going from the $1,600 we paid in FY20 to the 50% of the POMV draw in this scenario. Also, there is that revenue difference, but it's a combination of the two items. And then in FY22, that's the reason for the decrease from FY21 to 22 is the implementation of that. The full implementation of the sales tax. And then the continued reduction you see is because of spending growing slower than inflation in this scenario. And that causes, because revenue roughly increases with inflation, it would cause the deficit to shrink over time.
Representative Wolf.
Thank you, Madam Chair. So the black bar in the upper left, which is the budget, you're saying is going to not increase with inflation. It's easy to say that and move your bar down, but is that what would that look like as far as if we increase at half the rate of inflation is what you're saying? So the budget would go up very slowly over time, but things like, obviously we know that healthcare and other costs are going up faster than inflation. Medicaid expenses are going up faster than inflation, so that would have to be offset.
Medicaid, 100 million to 200 million supplemental every year since Walker did it.
To make that low growth attainable.
Through the chair, Representative Wool, that's exactly what would happen. For those things that are growing faster than inflation, then choices would have to be made to limit, reduce, or eliminate other services to keep under that.
Follow-up. And based on what happened, say, with last year's projected attempted budget cuts, that's easier said than done, this kind of slow growth type scenario, I'm guessing. And there'd have to be some political will to have a low growth budget. I mean,
You legislators would have to deregulate regulations in Medicaid, and those cuts can be done.
The growth has certainly been, well, there's been a reduction of 10%. As the pressure to keep spending down has been very significant over the last several years, there are things like the recent trooper salary increase of 7% that are going to take over any of that cost pressure pushed down. You're going to see other things that are going to be popping up. In order to accommodate those other things, then some service needs to be eliminated.
follow up. Or for example, the ferry system. If someone actually wanted to try to make it a little more functional, that would be a cost pressure up and would have to be compensated for a decrease in some other area.
Through the chair.
I guess I'm stating the obvious, but yeah.
Okay, moving on to the next scenario. This is one that shows a 50% of statutory net income after inflation proofing. The current dividend statute calculates the 50% of statutory net income that goes to the dividend before inflation proofing. So the inflation proofing is completely, essentially out of the government share. So that would result in actually a pretty similar dividend to what you see in this one, with the 50% of the POMV draw. You can see that it tracks very closely to the current statute, but a little lower, as that inflation proofing is borne by the dividend as well as by the general fund. And this would still result in deficits of about $1.6 billion in FY21, and then rising in future years based on no spending changes or any other changes as well. Questions about this one? Okay, so the next one shows, again, another one that's a little more complicated to explain, a $1,600 dividend with a, we're going to call it a progressive payment in lieu of taxes, where the dividend is reduced based to people's income. The projection based on the amounts that were given to me for that reduction would be essentially about a $400 million reduction of the cost of a $1,600 dividend. So if you had some sort of structure where if you had higher income, then you would not get your entire dividend, the state would hold some of that back, and if you had lower income, you'd get most or all of your dividend. The particular numbers, I think, were showing about a 20% reduction starting at between 25,000 and 50,000 of income, and then up to an 80% reduction of the dividend for a person who's making $100,000 or more. And so that result would reduce the cost, or that plan would reduce the cost of the dividend by about 40%, or $400 million. So this scenario shows that with a $1,600 dividend, although many people would receive less, and then that would result in a deficit in FY21 of about $850 million, rising to about $1 billion and level from there.
Representative Merrick.
Thank you, Madam Co-Chair. Alexi, when you say in lieu of taxes, so would children receive the full $1,600, assuming they are non-working?
Right, Representative Merrick, through the chair. Yes, this is assuming that children get the entire dividend, unless they're, a minor who has a significant income.
Thank you.
Representative Josephson.
Through the chair, so this is a not fully but partially needs-based dividend. Is that, or income-based dividend?
Representative Josephson, through the chair. Yes, this would essentially make the dividend larger for people with lower incomes or for children than people with higher incomes. Any questions about this one? Any more before we move on?
Representative Ortiz.
If we were to make that kind of a change to the dividend program, do we have any sense of what kind of administrative costs would be added to distributing the dividend? Minor or significant, or do you have any idea at this point?
Through the chair, Representative Ortiz, I don't have an idea.
Sure. but it would be safe to say that there'd be some added calculations that would need to be done. So at least at the short term, there would be some added cost to administering such a dividend.
Representative Ortiz through the chair. Presumably, there would have to be some sort of check, some sort of document submitted, and then employees checking those. So there would be some cost.
I would assume that it would be almost similar to having a tax audit of some sort. Representative Carpenter.
Thank you, Madam Chair. So I just realized that the some of the assumptions that we're making here on the price, I think it says price scenario, $40. We're projecting that through the entire time period here. Is that correct? What we're saying is $40 oil is going to be the new norm.
Right.
Okay.
Representative Lowe.
Thank you, Madam Chair. I just want to clarify. You said so if you made over $100,000, you'd still get 20% of your PFD, so $320. What do you made? $100,000, $200,000 on upwards? You still get that $320.
Representative Wolf through the chair. That is the assumption based on the scenario I was asked to prepare. And Representative Carpenter through the chair, if I can just respond a little on the price. The Department of Revenue changed its methodology so that essentially what they did in the fall was they took the futures market value for the next fiscal year and then increased it with inflation going forward. That doesn't necessarily have to be their assumption, but that is how they did their forecast. So to try to replicate that, that's what we did here. If you look at the futures market going out a little farther right now, it does grow a little faster than inflation and hits $50 in about FY20 or fall of 2023 or so. So that is a bit faster than inflation. So this may be over the long term a bit of a more conservative assumption than what the futures market would indicate, but this is using the methodology that was used for the fall forecast. So in the absence of a spring forecast, that's kind of our best guess at what the forecast will say.
Understood. Thank you.
And add one thing. If we do go to $50 a barrel, say 3 years from now, those numbers will change only moderately by 200 to 300 million.
Okay, so moving on to another scenario. This one assumes that all royalties, except for what's dedicated to the Public School Trust Fund, would go into the permanent fund rather than the current constitutional dedication of 25% plus 25% from newer oil fields. So the full unrestricted general fund royalties going in. It assumes that the growth rate would be limited to 0.5%, and that there would be a budget change of about a reduction of 500 million phased in over two years. This keeps a constitutional budget reserve minimum balance of $1 billion and instead fills the deficit with the ERA. So this is actually the first scenario we've seen that fills the deficits from some method. And the dividend formula in this one would be 50% of royalties, even though those are going to the general fund, but it'd be an amount equal to 50% of royalties plus 10% of the earnings of the permanent fund. And while I wrote that in as 10% of statutory net income, so you have something on the slide, it's really 10% of the most recent year's earnings. That's functionally very similar to the average, but it is slightly different in the first year. And so in this scenario, you would have a deficit of about 900 million or about $1 billion, but it would decrease over the period because of the lower spending growth rate. And with the minimum CBR balance, it would keep a CBR balance of $1 billion or so, a little more actually. And fill out the ERA, so I can answer more questions if there are about this scenario.
So I guess my only question on this is, because currently a good majority of our royalties are our oil income revenue, how does that affect, so that's in this model So our overall revenue picture would go down.
Yes, Chair Johnson, yes, that would reduce our unrestricted general fund revenue. In the $40 oil scenario, a little bit less than it would have in the fall forecast, but yes, it would cause a reduction to UJF revenue.
And then when you say in the draw, the delta here is an additional draw from the ERA besides the structured draw?
Representative Johnson, yes, that's the assumption in this scenario. And I may have skipped over quickly the budget change here. It would have been a reduction of $500 million phased in over 2 years, so a reduction of $250 million the first year, another $250 million in the second year.
Others have questions? Representative LeBon?
Thank you, Madam Chair. Maybe this is a question for Director Pitney with her background. At one time, the state was looking at a state income tax, and there was a cost associated with setting up Department of Revenue to collect a state income tax. Do you have some insight to share with the committee about how many employees would need to be added at Department of Revenue, or what the annual cost would be of collecting a tax?
Through the chair, Representative LeBon, the latest figures I've seen are anywhere from 8 to 12 million on whether it's a sales tax or a income tax, and I don't have a breakdown of the number of people, but you assume 50 or 60% of that is going to be people costs, and the rest is going to be contractual services and other support.
Follow up?
Thank you, Madam Chair. To follow up with Representative Ortiz's question about the administrative cost of a PILT, a payment in lieu of taxes, if we were to means test the PFD and set a threshold where above a certain income amount, the dollar amount would be zero, would you have a feel for how that might look cost-wise to administer, and how we would test the income? Would we require Alaskans to share income information, or would it be the honor system subject to audit? Or is there any thought about how a PILT, if a PILT would be cheaper, if we're after income, if we're after revenue, an income tax or sales tax probably will cost more to administer than a PILT. Is that a fair statement?
Through the chair, Representative LeBon, I don't have enough information to say if it would be significantly less expensive. I don't know, Alexi, if you have any insight.
Representative Bond, through the chair, I think it would depend on how that were structured. Again, if as you're suggesting there would be a 0% amount, it would probably cause a lot of people to just not file, and that would reduce expenses, versus if it's some people are getting at least some amount. And it would really depend also on how large the dividend is, because that would determine how much of an incentive there would be to attempt to prove your income is low enough to get that.
Good point.
Representative Josephson.
Through the chair, in keeping with Representative LeBon's question, if there were a flat tax that didn't require people to itemize and complicated state schedules, etc., I assume that's easier and cheaper to implement than some of our own independent income tax with variable rates and the like. I assume that's got to be true.
Representative Josephson, through the chair, my recollections of the hearings on House Bill 115 a few years ago would, I guess, confirm that. Because if you use especially just the federal tax as your basis, it is simpler to administer, because you can just require the federal return and then base the tax off of that and piggyback on the IRS's work.
Representative Kelly? Representative Merrick?
Thank you, Madam Co-Chair. Alexi, is there any data on how much of Alaskan permanent fund money goes to the federal government in taxes?
Representative Merrick through the chair. So the last real study of this that I've seen was from the 1980s, so it may be a little dated. Based on that, I think for the Permanent Fund Working Group, I was asked to do a little estimation of that, and my best guess at the time was about 15%, based on current federal tax rates. Yeah.
So when I look at scenario 9 and I compare it to scenario 2, it seems that the growth in the fund is quite similar, and the impact on the earnings reserve draw are quite similar. The big difference between the two scenarios is the CBR. Am I...
Representative Johnson, yeah, I mean, essentially, it's holding that $1 billion in the CBR instead of the ERA. That's going to be the biggest difference. And then that one, you know, the requester asked to actually show how the deficit would be filled. This one, the requester did not ask, so I didn't assume. But I think the effect in the end is fairly similar based on this forecast. Because the dividend would be based on oil revenue in part, it's a little more sensitive to different oil forecasts.
Can I get a clarification on something you just asked?
Yes, Representative Josephson.
Through the chair, Mr. Baker, you said that in the former case, the CBR, you said something about the money is held in the ERA as opposed to the CBR. What? You're just referring to this ERA overdraw, right?
Through the chair, Representative Josephson, I think the difference I was referring to is whether we keep $1 billion in the CBR or not, and the difference is just which account that billion would be in. It's not assuming that there's another $1 billion in the system, just in a different account.
I see. Okay, thank you.
I think we have one final scenario here, scenario 10. This shows the only change here is to go with 1/3 of the POMV draw to the dividend. This was, I believe, the House version of Senate Bill 26 2 years ago called for this dividend level, although it also called for a tax. House Bill 115 that we just discussed. So this scenario, the dividend would be about $1,500 per year, and it leaves a deficit in FY21 of about $1.2 billion, rising to $1.4 and $1.5 billion in the years beyond. So in this scenario, the constitutional budget reserve essentially would run out in the end of FY22. I think this is an error that there's a small amount showing in there.
So, if we went back to scenario 1, the governor's amended budget, and we take the information that we started with as far as what we're looking at for revenue sources this year and next. And I know for our working group, we did scenarios of a net dividend. Just looking at this, actually, what would be a net dividend this year?
Madam Chair, there would be a zero dividend if it was the surplus essentially going to dividend, because in FY21 and all the years in the forecast of $40 oil, the size of the budget is greater than revenue even before paying a dividend.
Representative Carpenter?
Thank you, Madam Chair. Alexi, can you explain to me on model number 9, why the revenue in the upper left-hand corner is much less of a projection from all of the other projections.
Representative Carpenter, through the chair, that's because the portion of royalties that's being redirected from the general fund to the permanent fund.
Okay, follow-up question.
Follow-up?
When you project out the balance of the permanent fund past 10 years with an additional $1 billion being added to it, well, not an additional billion, but a total billion, what happens to the permanent fund value long-term in these comparables? Is that something that we can look at?
Through the chair, Representative Carpenter, I do have a 20-year model of the permanent fund. It's not part of this presentation, but in adding additional funding to the principal of the permanent fund, obviously in this scenario we're spending that extra to meet the budget deficit, but in the absence of that would result in inflation adjusted growth to the permanent fund. Senate Bill 26 as written essentially does not lead to inflation adjusted growth in the permanent fund because the percent of market value draw of 5% is essentially all of the real earnings of 5% that we project. So it essentially, while the permanent fund seems to grow in nominal terms, in real terms the permanent fund is pretty level. So adding these additional royalties would be a way to actually cause the permanent fund value to increase.
Follow-up?
Follow-up?
Do any of the projections or the models that we have here account for the roughly $1 billion of inflation proofing each year that would be needed?
Representative Carpenter, through the chair, I think, for all of them, we're assuming no further inflation proofing for 4 years. So for the ones beyond, that's why a lot of these you do see an ERA balance that's declining. If we go to scenario 2, for example, we see the ERA increases and then flattens out because, essentially the inflation proofing amount plus the POMV draw accounts for the entire earnings each year of the permanent fund.
Lexi, I think this is a great opportunity. Could you define the difference between nominal and real?
Sure. So nominal is just dollars as you see them, and then real is adjusting for inflation. So, when we're looking out 10 or 20 years, when we say something is $1 billion today at 2.25% growth, it's a significantly larger amount for the same buying power. So real dollars, $1 billion today is $1 billion in FY29, but in nominal dollars, there would be a larger amount. So when we see like this budget line here, for example, this is all in nominal dollars. So you see that it increases, but in real terms, when you account for inflation, the budget is flat because it just grows at the rate of inflation.
Representative Josephson.
To the chair, Mr. Painter, yesterday's presentation, which I wish I could have back, at slide 16, and essentially it showed a balanced budget with a 80-20 reform, but it was based on a fall forecast, and so the main difference is the effect of the Russia and Saudi shenanigans and the coronavirus and the downturn in the stocks, right? Is that why I can't mainly have yesterday's presentation back?
Through the chair, Representative Josephson, I think even a week ago I was in front of the finance committee and the other body, and I told them that we were looking at being down in 1 to 200 million in revenue. So even then we were below the forecast, but not nearly as much as we're saying this week. So yes, that presentation on Monday or yesterday I guess was based on the fall forecast, which the last week has made a little obsolete.
Follow up on that. Back to a net dividend, and currently, even with a net dividend, we are in deficit spending with the governor's budget. Is that correct?
Yes, that is correct.
And so, looking out at the CBR, we would still be drawing from the CBR. And do you, actually it might be a good thing to model for the committee?
Sure. We can switch to the live model now if you'd like and show, I called it the balanced budget dividend at the time, but essentially, fortunately it goes negative, but it shouldn't, it's a zero dividend. So, and this essentially shows that,
That would be a tax, right?
yeah, I think it's showing that we're not getting rid of the permanent fund dividend division in this scenario, so we keep paying their budget, but we do that out of our budget, not out of theirs. Anyway, so this shows essentially that with a zero dividend that we show a continued deficit because of the supplemental. If you assume no supplementals, it'd be a balanced budget, and so the CBR value would increase over time because there would be earnings and deposits in there, but no draws from it.
And have we ever had a year without a supplemental?
Representative Johnson, I believe we've had years with very small ones, but I don't think we've had one with no supplemental, although FY15 we ended up, I believe, negative overall. That was the year that we had the massive oil price crash during the year, and we went back. I think we may have ended up negative, but I'd have to double check that.
And with this scenario, though, you have on the deficit, could you read that number out because it's a little small print?
Sure. So this shows a deficit of 0 in FY21. If that's
and our FY20 deficit is
638 million based on the dividend that we paid last fall.
And if you had the supplemental back up to 50?
So this shows a deficit of 50 million that would be the supplemental, because you wouldn't know that when you're calculating your dividend each year.
Representative Josephson?
Through the chair, Mr. Painter, if as I guess predict, there will be a significant CBR draw to pay a modest dividend, is the danger in delaying serious revenue discussions to January principally that you have to stand up the new revenue generation systems, or is there something about a further draw on the CBR, say from 2 billion to 1.3 or 4 billion, that is damaging, assuming that we move quickly to a revenue discussion? Does that make any sense? When I say quickly, I mean in January.
So, Representative Josephson, to the chair, I think the danger in delaying is that even there will be some time to set it up, but also you get only half of year's revenue that first year. So if you still are leaving a deficit, and if we left here expecting a $1 billion balance in the CBR, if you had a tax that was proposed next year that would entirely fill that deficit, you'd only half fill your deficit next year. So you need to leave a little bit of a runway if you're proposing a tax to make up that amount.
Follow-up? Representative Wolf?
Thank you, Madam Chair. Can we return to scenario 8? The budget curve on the upper left, which takes a dip and then I assume goes forward at inflation still. And I see you have a $400 million budget change. But I don't understand where that comes from, because what you're saying is you're going to pay out a progressive or differing PFD depending on your income. So wouldn't that change the PFD curve and not really change the budget curve? Because you're still spending on all your essential state services, just the PFD is going to come down. And you have a budget line without dividends.
Through the chair, Representative, well, you're correct. I think just for the sake of making this a little easier to model rather than overwriting a bunch of formulas about how the dividend works, I just assumed it would be a general budget change. But you're correct that the true impact would be a reduction to that dividend cost, not to the budget. That's just sort of simplification for the sake of making it easier to model.
Thank you.
Are there any more questions? And if you could get me that one more model, I probably should have asked for that earlier, but in case anybody wants to have that, you could maybe email it to the committee.
Which,
the net dividend.
oh, so we can, and really a more accurate way would be to stop paying the dividend.
Yeah.
The dividend division, so just show zero dividend, and then we do still have a deficit in that period. So I'll send that to the committee.
Great.
I think a follow-up here is at $40 a barrel oil and the current spending level, there's no scenario without a deficit with any level of dividend or the spending level we're at. And at $50 a barrel oil, it's nearly the same. I mean, it's not as much deficit, but it's still
a deficit.
So it's not until you're in the mid-50s that you, at the current spending level of services, let alone a dividend, before you're balanced.
Representative Foster.
Thank you, Madam Chair. On that, so at current spending levels in the governor's budget, the surplus for the governor's budget was it I think around $435 million. Is that correct? Not including the PFD.
Through the chair, Representative Foster, that's true with the fall forecast. Yeah.
Okay, and then if you take into account the projection based on $40 a barrel oil for both FY20 and FY21, I think we're looking at a shortfall. I know, Ms. Pitney, you had one scenario where it could be, I think, as low as minus $300 million for FY20 and minus $550 million for 21. So you're looking at a shortfall of $850 million. So if you've got a surplus of $435 million, but now a revenue shortfall of $850 million, that I guess that's just another way of looking at the deficit that you're describing. So thanks.
I think, another kind of instructive point is in considering the governor's amended budget, the CBR would be completely depleted and we wouldn't get through the fiscal 21 period.
Representative Josephson.
Through the chair for either testifier, and I know this isn't necessarily your area of expertise, but these depressed prices will have some impact on exploration development, and unless the company's own expertise suggests that there's a brighter future, and then it occurs to me that, of course, the initiative would arguably solve some of these problems, but also could seriously depress exploration and production as well. Those are other factors that are very, very hard to describe. Am I right about that?
Through the chair, yes, Representative Josephson, that those two in combination don't particularly bode well. But again, at $40 a barrel oil, an increase to the minimum tax doesn't add a lot of money. It's still they're at the very bottom.
Representative Wall.
Thank you, Madam Chair. I guess these forecasts are sort of a big part of our discussions here, and that it's so volatile. Not that long ago, we're looking at $60, now it's $40, and of course, low prices affects production. There could be a geopolitical event that could bump it up again, and my understanding is that some of the reason for the decrease is a political event and not, say, just the coronavirus, although I know that plays into it as well. So obviously it's complicated. I guess going forward, is the state trying to be less responsive to the price of oil in making these budget or when we see the price go up and down, do you really want to look at these 10-year projections based on a
$50, or do you want to plan for?
Is the state trying to be less responsive? To the price of oil in making these budget or when we see the price go up and down, do you really want to look at these 10-year projections based on a price that we all know that we don't know what it's going to be, and although experts are saying they don't expect a big rise. And when you look at these prices at $40 that we didn't look at a month ago, it's pretty sobering that even if we don't pay a dividend, we have a deficit. And how to deal with a situation like that. And we've already said we don't really want to go into the earnings reserve. And I haven't heard too many people say they actually want to have a zero dividend. So it's really a conundrum. I don't know how it puts ledge finance or OMB people or people that have to come up with a budget, but these scenarios aren't very they're pretty grim unless you really depress the budget. And those scenarios that kind of work are where you have a low budget, lower than inflation, and I can't imagine what that would do to the economy as well. So I don't know.
So Representative Wool, in a follow-up, in the past we have had geopolitical situations that have changed the price of oil up, and that has been almost the standard. And if you remember, this year there was a geopolitical event in the Mideast, and it went up for 2 days, and it drastically dropped right afterwards. So I think, personally, I feel that we have to start thinking of a new era, that we can't think of things in the way we used to think of things.
Follow up, just and then I'll pass the baton. But on that note, the geopolitical, the other thing that we're seeing that's a financial political, which is a lot of investment banks are, for political or environmental reasons, are saying we don't want to invest in certain kinds of carbon extraction. So that's playing into this as well, I think.
And I think, at least I know one of our companies that are heavily involved in the state of Alaska, that all their plans are around $40. The break even is $40. Representative Josephson.
Thank you. Through the chair, I think the other thing, and it's more a comment, but if you want to reflect on it, that would be welcome. So traditionally, the number that was bandied about in the 80s and 90s and aughts was that we were 90% dependent on oil, and now we're 40%, and it's still too much dependency. It's just way too much dependency. That's the main thing I'm taking from this. Do you have a thought about that?
Through the chair, Representative Josephson, we're under the old forecast, we were 40% dependent on oil. Now we're 30% dependent on oil. Yes, we have two main sources. Both of them have their own volatility. Oil, of course, more volatile. The price reductions are more actually less problematic than they used to be in 2015 when the price dropped. We went from a forecast of 3.9 billion to 1.6 in actual revenue. We don't even have 1.6 in actual revenue in the forecast, and we're dropping significantly below that. So you have the volatility of oil, then you have the volatility of the markets. Now that volatility is somewhat delayed, but we're still in a volatile market. In 2008, when the market crashed, oil went up. In 2014, when the oil crashed, the market went up. What we're seeing right now is both oil and the market going down. And you add on the coronavirus pressure, you're seeing less demand, you're seeing less transportation. There's many other things. So as a price war that got us the price drop. But you also have this whole supply and demand difference that's coming into play. So that's hitting the market. So both of our main streams are on the negative end. And in our state, we don't control those. Both of those are world commodity, world market issues. So right now, the state has very little of its revenue in its own control. And I think that's another kind of destabilizer to our state budget is how do we have something in our state revenue stream that follows the success in our state, and when we don't have that.
Representative Wall.
Thank you, Madam Chair. Through the chair. So if oil's gone from 90 to 40 to 30, and if that graph continues, it won't be good. And let's say we become a state that gets most of our income from a sovereign wealth fund. This scenario here with a zero dividend, and we'd still be drawing from the CBR. And you show the balance of the reserve, and I think that's earnings reserve. I assume the permanent fund itself would grow, and therefore the POMV draw. And it looks like it's growing there too. So I mean, if someone said, well, oil over the next several decades, 40, 50 years is gonna wane, and we'll just live off our savings and the earnings, assuming the stock market doesn't do anything hyper crazy over that many years. In this scenario, the permanent fund would grow, and therefore the POMV draw would grow. And at a certain point, if we had to live on 90% POMV draw, as long as it was steadily growing, we could maintain a budget of a certain size. Is that correct?
Representative Wolf through the chair. It's growing at the rate of inflation. So if your budget also grows at the rate of inflation, then you can't shift towards reliance on the percent of market value draw. Unless your budget grows slower than that draw grows, either you're drawing less than 5% or your budget is growing slower than inflation, then we can't become increasingly dependent on POMV. It essentially would have to be the same percentage of our budget every year, if that makes sense.
Not sure.
Representative Wall.
Just get in the queue.
Yeah. Well, so I'm maybe a misunderstanding. So if the permanent fund grows at, say, 6 or 7%, and we draw 5, then the remaining is just your inflation. So the 5 plus inflation is about what we're growing at, and that's how we chose 5%, because it was the average growth minus. Got it.
Representative Sullivan Leonard.
Thank you, Madam Chair. I guess my question is, as we look at the different models that we've just talked about, which one offers us, I guess, the best security in the sense of, the reality of the deficit that we have before us? Which is the closest for paying the closest amount to reduce that deficit, and then offer, I guess, some sense of revenue security, at least a little bit going forward, as well as security for the CBR? Is
None.
there a model here that you're seeing today that offers us this?
Not a single model. None.
Through the chair, Sullivan Leonard, each of these are a huge policy call. If you look at the live model that's presented here, it doesn't have a dividend. Your CBR is not depleted for 10 years. Well, not 10 years. It's depleted in 7 years. But that's a policy call versus if there were to be an additional revenue amount of money, or if this body felt like there could be a service cost reduction. I think with the significant supplemental that came in from the governor after last year's reductions, I think that one is. I think people are beginning to realize that that's a harder. Reductions are harder than what seemed to be the case. But there could be revenue. There could be the dividend changes. The security of the CBR leaves the state in a good position to make sure the POMV continues to take the same proportion of the budget going forward as it does today. And I think that's the thing. Protecting the value of the permanent fund so it grows in real terms, so that it can cover the same proportion of the budget today or tomorrow as it does today, I think probably is the biggest security question. Then the other is, what is prudent to expect in oil revenue? And do you want to plan for $50 or do you want to plan for $40? And if so, then take advantage maybe of the good years of oil to make other policy calls if you plan conservatively on oil. But the biggest proportion of our budget right now is this percent of market value. And protecting that revenue stream from here forward is probably the most important consideration. And then it's the policy call around those.
Representative Carpenter.
Yeah, I was just thinking of something that was said earlier about inflation and spending increasing in inflation. And right now, for the majority of these scenarios that we've looked at, or a good number of them, our current revenue doesn't even get us up to the budget. So we're talking a tax or some additional revenue to get up just to the level of spending. But then we have to do that again next year, and the spending has grown by inflation. So what does it look like if we're going to solve that problem by creating an income tax or a sales tax? What's the increase in tax each year to keep up with the inflationary growth of government? We can agree to a $500 million tax this year, but it's not 500 next year. It's plus 500. It's 500 plus next year, and 500 plus the year after that, because somehow we got to keep up with the growth of government. So what does that look like on a graph?
Through the chair, Representative Carpenter, I think in our assumptions, we assume that those tax rates grow with the rate of the economy, and that's, again, roughly at the rate of inflation. That may not be a reasonable assumption if the last few years our population has actually decreased. So I'm not sure that that's a correct assumption, but that is the assumption that we have, is that they grow at inflation.
I think that over the last 10 years, at least the data that I saw from 2006 to 16, our economy grew at like 1%.
Right.
So is it fair to assume that we're going to have a tax of any sort grow at 2.25% or greater if our economy is only growing at an average of 1% over a decade?
Representative Carpenter, through the chair, I think that's a reasonable concern. We've used this inflation as the growth rate for pretty much everything, but that may be an overestimate of how fast tax revenue might grow.
Another follow-up that is just a risk here. If you add a $500 million tax, say it's an income tax or say it's a sale tax, either one, and what effect does that have on your ability to produce within your economy? Your private sector takes some sort of hit. I know ICER published these numbers of months ago, but you start a spiral, right? Where you're increasing taxes every year to keep up with your spending, and yet those increasing taxes have a negative effect on your ability to produce wealth within the state from your economic engine. And so in all of these scenarios, we're considering that our spending level just keeps increasing because that's what government does. It just continues to increase. But we're 700,000 people and we only have a certain size of economy. And if we're going to solve our problem by taxing ourselves, we're going to have to continue increasing that tax to keep up with the growth of our government.
Madam Chair.
Is there a follow-up to this, or Representative Josephson?
Well, under a brief editorializing, I mean, I believe that if any governor, I've imagined that any governor of Alaska, not this one, any governor, to go to the National Governors Conference and say, I've got a real problem. My state has $65 billion, and we're trying to remain the only state that doesn't tax its people. His or her 49 colleagues would walk away. The violins would be very small violins. So I mean, we have the solutions. We just.
And these will all be discussions that we'll have. These are the policy discussions, and these aren't the discussions. Ledge Finance, I am always concerned about dragging them into policy discussions when we're asking them for numbers. And you make a very good point, Representative Carpenter, but that's also why I want us all to, I mean, we still have to keep in mind real cost, real numbers versus nominal, because sometimes we do get ourselves into trouble when we look at it in a nominal way. So our modeling has to account for something, and we have to account for some inflation. I do know our president has spent quite a bit of time trying to drive up inflation to make his numbers work. He wants inflation. We've had flat inflation after 2008. You're quite right. In fact, we've pretty much had deflation, and we do not want an economy of deflation, because then the economy doesn't grow. But it's all a matter of policy and a discussion. But right now we're just modeling what we have right now, and I don't think, I think you as a policy person could start modeling or going to ISER and looking at the impact of different taxes. Representative Ortiz. Anyways, I think today's been a very, very enlightening discussion. I think it's been very sobering. And I hope we've all gotten something out of it. That nothing is easy, and nothing is as much as it would. Yeah, the easy days are gone, basically. So, our next meeting is on Thursday, March 12th, 2020, at 9 a.m. We'll be taking up House Bill 268, Muni Bond Bank, which involves University of Alaska loans and bond limits. And we'll be considering the governor's appointee, Lucinda Mahoney, who's been appointed to Commissioner of Department of Revenue. And we're adding also House Bill 181, which was the public schools mental health education that we were unable to get to before. We have some amendment deadlines coming up on Thursday, March 12th at 5 p.m. House Bill 185, the registration of boats exemption. So that's 5 p.m. Thursday, March 12th. House Bill 24, limited teacher certificate language. That's also Thursday, March 12th, 5 p.m. Friday, March 13th, Friday the 13th at 5 p.m., which is one day later. We'll have public schools mental health education, House Bill 181. And Monday, we're looking at March 16th at 12 p.m., House Joint Resolution 15, the Constitution Amendment voted needed for veto override. So those are your amendment deadlines. Again, Friday the 13th for House Bill 181, Monday the 16th for HJR the 15th. And do the members have anything else they'd like to add today? Hearing nothing, meeting's adjourned at 3:18. Thank you very much.
Thank you all for tuning in today. We just got to listen to basically what they had in October of last year. The Bicameral PFD Work Group, the group of 8 or 6 were there that were looking to completely steal the PFD. That was the 6 plans that they presented to us today. Not a single one of their plans includes inflation proofing of the PFD. It does not include cutting one single penny of the actual budget anywhere in it. Not a single plan assumes that our PFDs are to be paid statutorily, and it does assume that government state spending for the special interest will increase approximately 5% each year. They say 2.5, but the numbers actually branch out to closer to 5% each year. And they will continue to keep growing the budget to where with all 6 of their plans, they show within 10 years, the CBR being completely wiped out, the ERA, earnings reserve account, also being in around the same shape of being completely wiped out. They're hoping that there'll be enough left in the corpus of the account to continuously generate the funds that they need and want. Not that they need, that they want to pay for the special interest of Alaska to pay for the budget. It is just absolutely outrageous to know that they are stealing somewhere around $3 billion a year right now for the last 4 years from the ERA. That has fluctuated between $2 billion and $3 billion. They even admitted that today that if they were to completely eliminate the PFD out of the budget, do not do a single budget cut, they could increase the cut budget and they would just have a slight deficit for what they have available that they would have to pay with the CBR. Of course, they did not present this plan to us today. They did not show us this plan. This is something that they're going to be handed behind closed doors because it's been requested, but it's going to be handed behind closed doors so that us Alaskans don't get to see what this actual deficit they're talking about without paying a PFD would be. Right now, they're saying their $1.2, $1.5 billion deficit that they have would be closer to a $200 million deficit. Can we hear the concept behind this? Pay us no PFD, completely eliminate it from the budget that they have sitting in front of them right now. They have about a $200 million deficit that they could easily cover from their CBR. Or, do what they've been doing. Take their extra 5% out of our ERA and go ahead and spend it on it anyways. Now, can someone please explain how a $200 million deficit on their state budget from tax revenue equates to them stealing $2 billion from the ERA every single year for the last 5 years? It doesn't. Nothing that they're doing justifies the theft that they got going on. All 6 of their plans, they're covered in full detail to what's pinned to the top of my page. It talks about the Bicameral PFD Work Group. I'm not very nice in what I have to say about that work group and what they came out with that. The PFD-Budget Tool that they have sitting there is what they are discussing here today. There is a link there to go directly to the tool and play around with it. If you eliminate the permanent fund dividend payment completely out of their tool, they have a $900 million surplus sitting there. Quote, a $900 million surplus if they do not pay us our PFD using their PFD budget tool that they came out with that goes along with the 6 plans that they just got done discussing today. Even with the lower income amount, it equates down to closer to $500 million. Yes, our permanent fund has taken a big hit because the stock market has dropped 1,700 points, and it continues to keep dropping, and people are all in a panic because of the coronavirus. Stock market likes a stable environment till things stabilize and the far left mainstream media quits hyperventilating about this virus that statistically has caused less deaths than the normal flu itself has caused. Only difference is there's supposedly no cure for it. And at this point in time, okay, I have a really hard problem seeing why they're hyperventilating the way they are when they've had other viruses that came out during Obama's term that killed thousands, tens of thousands of people, and they never hyperventilated once like they're doing with this H1N1 virus, the swine flu virus, you name it. There are several of them out there that have happened. Did you see the pandemic that they're having over this? The hyper-hysteria that they're pushing on this? They're purposely trying to drive the economy into the tank so that they can justify trying to eliminate a president that they don't want in office. The sad part is we've got legislators sitting in Juneau right now. You can see them all sitting in that room. There is only 2 people that I see sitting in that room right now that cares about following Alaska laws. Every single person that is sitting in that room besides those 2, 100% broke 6 of our laws last year. Our constitutional laws, our statutes, and the laws that are associated with those statutes that they have passed. Completely ignored, broke them, no consequences, just like the Democrats get down in Washington. No consequences when they break the law. But if the 2 people in that room that I see right now was to stand up and say something, they would be stripped of all committees. Their constituents they represent would no longer have a voice. In fact, both of them have already had this happen to them, just not to the extent that Senator Shelley Hughes and Senator Mike Shower and Rep. David Eastman and Representative Reinbold, Senator Reinbold, all those other people have had their names just completely destroyed. Our voices, constituents that they represent, no longer have any representation in Juneau. Again, this bill, HB300, is completely covered on what's pinned to the top of my page by the Bicameral PFD group. I suggest you read through that if you haven't already. When I put out something that's long and lengthy, I guarantee you I've done the research to know that it's 100% accurate. Look at it. You'll see what they're trying to do in Juneau right now. It turns our permanent funds ERA permanently into tax revenue. And you heard it several times today by the chair and several other of the people that are sitting in there, that they already look at our ERA as tax revenue. It is no longer a account to hold our earning reserve for our permanent fund dividend. It is an account for them to use as taxes to spend on the special interest in the budget. They're more concerned about not having the money to pay for the budget than they are about not being able to pay us a PFD. Their concern for the PFD only comes when it comes to the outrage that they're going to have by us when people realize what is going on. Again, don't forget to share. Facebook does squeal on you if you don't share, so share this far and wide. Alaskans need to learn the truth. Also, if you haven't done it yet, go and subscribe to our YouTube channel. YouTube, we're Politic at YouTube. Subscribe, become a member. Sooner or later, we're getting there right now. We're uploading brand new videos daily into the YouTube. We're hoping to be able to we broadcast live on Facebook. We'll be broadcasting live on YouTube at the exact same time. That way you'll be able to get it at your favorite sources, no matter what it may be. We're going to be branching out far and wide. Thanks y'all for coming. Have a great day. Got one more live stream coming today. I guarantee it. I've got a community meeting to go to for the Chugiak MEA Association later on this evening. Have a good one.